Right, working through some example problems for Chapter 5. This chapter has us looking at the accounting for the purchase and sale of inventory. For this first example, we are going to prepare journal entries to record the following transaction on Monroe Company's books. Monroe uses a perpetual inventory system, meaning as soon as an inventory transaction occurs, it is immediately recorded into the accounting system. So on March 2nd, Monroe sold $900,000 of merchandise to customer Churchill Company. Terms were 210 net 30. We read that as Monroe offered Churchill a 2% discount if they pay in 10 days. If not, the net amount of the invoice will be due in 30 days. The cost of the merchandise that Monroe sold to Churchill for $900,000 had cost Monroe $620,000. Let's record a journal entry or prepare a journal entry to record this transaction into the accounting system. Every time we sell inventory, there are two transactions occurring. Inventory is sold, so a revenue is earned, and an asset is used up. We need to record two journal entries. The first journal entry will record the revenue being earned. When Monroe sold the inventory, they earned a revenue. We will record that as an increase to our revenue. Revenues have a credit balance, so to increase revenues, we will credit the sales revenue account for $900,000. Churchill has not paid Monroe for this. Monroe billed Churchill, so we need to record a receivable from Churchill on Monroe's books. So receivables are going up. Receivables are an asset. To increase these receivables, we debit them. So this journal entry will be a debit to accounts receivable and a credit to sales for the price that the inventory was sold. We also need to record the fact that an asset was used up to earn that revenue. Merchandise inventory is the asset that was used. Because the inventory was sold, the inventory is decreased. To decrease the inventory asset account, we need to credit it. When we bought the inventory, we had recorded it as an asset at the original cost of $620,000. That's how much we need to take out of the inventory account. We decrease inventory by the cost of the inventory we have recorded in there. As we use up inventory, it becomes an expense, just like all other assets. The name of the expense when we use up inventory to earn a sale is cost of goods sold. Remember, this is kind of tricky because it doesn't have the word expense in the name of the account, but it is absolutely an expense. It is just like it's just like salaries expense, rent expense, insurance expense. It's just named cost of goods sold. So there are the two journal entries when the inventory was sold. The next thing that occurred is on March 6th, Churchill Company returned $120,000 of the merchandise that they had purchased on the 2nd. The cost that the returned merchandise was to Churchill was $90,000. If this was returned, Monroe has essentially lost some of their revenues. Instead of directly reducing the revenue account, we will use a contra revenue account to keep track of how much of the revenues were lost due to sales returns and allowances. Contra revenue accounts have the opposite balance of the account they're tied to. Sales returns and allowances is tied to the revenue sales account. Sales has a credit balance, which means its contra account is going to have the opposite balance or a debit balance. To record an increase to that contra revenue account, we will debit the sales returns and allowances account for $120,000, increasing that contra revenue account. We have more returns and allowances. Because the customer returned some of what they bought, they no longer owe for it. So we also need to decrease the accounts receivable that we have recorded from that customer. At the same time, not only are we giving up revenue, we are also getting some of the inventory back we had previously recorded as sold. Because it is coming back, it is not really sold anymore. We're going to reverse the entry we recorded when we sold it. So we will increase inventory again. The asset account is increased with a debit for the cost of the inventory that was returned. We need to decrease our expense. This is one of the few times we actually decrease an expense account. And that is because we no longer have that expense. That inventory came back. Finally, on March 12th, Monroe received the balance due from Churchill for the purchase. Remember, Churchill originally owed Monroe $900,000, but when they returned $120,000 of it, they no longer owe that amount. So the total amount that they actually now owe is no longer the $900,000. They returned $120,000 of it, so they actually only owe $780,000. That's how much they are paying. So the accounts receivable is being paid off for the full $780,000. Now the full receivable is being paid off, but recall that Monroe told Churchill, if you pay within 10 days, you can take a 2% discount. The purchase was on March 2nd. Monroe paid on March 12th, right within that 10-day period. That means that to pay off that account receivable of $780,000, Monroe does not need to pay the full $780,000 in cash. Monroe really only needs to pay 98% of that, or 2% less. So we're going to take the $780,000 and multiply it by 98%. Actual cash paid will only be $764,400. Monroe's cash will increase $764,400 for the cash received from Churchill, so we will debit the cash to increase it. The amount of the sales discount, or the amount of the revenues given up due to the discount, is the $780,000 times 2%, the amount of the discount, $15,600. Again, we don't directly reduce the revenue account. We use a contra revenue account to record how much of the revenues were given up due to the sales discounts. Thus, contra revenue account has the opposite balance of revenues. Revenues have a credit balance. It means the contra revenue account has a debit balance. We will increase the sales discount by the amount of the discount provided or given to the customer for prompt payment. Now we are going to record all of these same transactions. However, we are going to record them on Churchill Company's books. So instead of recording journal entries into the seller's books, we are going to record them into the buyer's books. So let's prepare a journal entry on March 2nd to reflect the fact that Churchill bought $900,000 of inventory. The inventory cost Churchill $900,000. We will increase our inventory for $900,000 to record the cost of the inventory purchased. We haven't paid for it yet, so we also need to record an increase to the liabilities. Debit the asset to increase, credit the liability to increase. On March 6th, when Churchill returned $120,000 of the merchandise they purchased, we need to show that the inventory is no longer owned by Churchill. We returned it, so we need to decrease Churchill's inventory. We credit an asset to decrease, and we no longer owe $120,000, so the liabilities also decreased. To decrease the liabilities, we will debit it. Finally, on March 12th, when Churchill pays Monroe, the amount that Monroe now owes is not the original $900,000. Monroe has a liability now for $120,000 less because they returned some of that inventory. That means they now have a liability of $780,000 that they need to pay off. They're going to pay off the full liability. We will decrease accounts payable by the full $780,000. Now remember, Churchill was offered a 2% discount if they paid in 10 days. They paid within 10 days, so they do not need to use $780,000 in cash to pay off the full liability. They only need to use $764,400 in cash. So So their cash will decrease $764,400, so we credit cash. We debit the liability for $780, and the difference between the original purchase price and the discount taken needs to adjust the inventory account, because the amount we have recorded in the inventory account for the purchase must always reflect its actual cost. This inventory was originally recorded at $780,000, but it actually only cost them $764,400 due to the discount. That's why we are now decreasing that inventory. We are crediting the inventory account to reflect the fact that it actually costs $15,600 less as a result of the discount. Let's do another problem, using the same concepts that we were just discussing. Paul's Book Warehouse distributes hardcover books to retail stores and extends credit terms of 2% if the bills are paid in 10 days. If not, the net amount is due to 30 to all of its customers. At the end of May, Paul's inventory consisted of books purchased for $1,800. During June, the following merchandise transactions occurred. So Paul purchased books on account for $1,200 from Logan Publishers. The terms are FOB destination, which means ownership of this inventory will transfer once it arrives at its destination. The terms are 210 net 30. Let's record that purchase. Let me get this all into one screen for us. Okay, that's a little better. So here we are purchasing the inventory on account, increasing the inventory account with a debit, and increasing the liability with a credit. On June 3rd, Paul's Book Warehouse sold books on account to Reading Rainbow for $2,400. The cost of the books is $1,440 to Paul. Remember, 2 journal entries are required every time we sell inventory. We need to record the revenue being earned, and we need to record the inventory being used up and becoming an expense. Recording the revenue being earned, we are going to increase accounts receivable, an asset, with a debit, and credit the revenue account sales with a credit. We also need to record the cost of the inventory being used up. The revenue is recorded at the selling price. The cost of the inventory being used up is recorded at its cost. We will decrease the inventory account, $1,440, and record the expense of that sale by debiting cost of goods sold, thus increasing the expense and decreasing inventory. On the 6th, Paul's received $100 credit for books that were returned to Logan Publishers. Remember up here, Paul purchased books from Logan. Some were returned and received a credit from the seller. That means that the inventory is no longer owned. It was returned, so inventory needs to decrease with a credit. And the liability decreases as well because it is no longer owed. Debit the liability to decrease. We received payment on the 15th. I'm sorry, I skipped one. We paid Logan Publishers in full. Remember, we originally recorded an account payable of $1,200 to that seller. But on the 6th, we decreased that account payable by $100, meaning we now have a liability of $1,100. We are paying off that full liability. To decrease the liability, we will debit it. We do not have to pay the full $1,100 to pay off that liability because we were offered a 2% discount if we paid in 10 days. We did pay within 10 days because we paid on the 9th, 8 days after the purchase. That means we get to take a 2% discount. $1,000 was the original purchase price, or times the 2% discount, we are taking a discount of $22. Instead of $1,100, we only need to pay cash of $1,078. In order to record the fact that the inventory cost us $22 less, we will decrease the inventory by $22. One thing I want to point out here, sometimes it gets confusing as to whether when you're dealing with discounts you are directly decreasing the inventory account or you are using a contra revenue account, the thing you need to keep straight in your mind is if you are dealing with inventory that was purchased, you are directly adjusting the inventory cost. However, if you are dealing with inventory you sold, then it's a revenue, and then you're dealing with the contra revenue account. Right, on the 15th, we received payment in full from Reading Rainbow. Recall that back on the 3rd, we had made a sale to Reading Rainbow, and we recorded a receivable from them at $2,400. They are paying off that full amount. Now, we had offered them a 2% discount if they paid in 10 days, but look, we sold on June 3rd, and they paid on the 15th. That means they did not pay within the credit terms, so they have to pay the net amount or the full amount of the invoice. Thus, the amount of cash we receive will be the full $2,400, debiting cash $2,400, and paying off the entire receivable. We will decrease our receivables by the full $2,400. On the 17th, we sold books on account to Willow Bookstore for $1,300. The books had cost $780. 2 journal entries need to be made when we sell inventory. We record the revenue being earned by debiting accounts receivable and crediting the revenue. We also need to record the cost of the inventory that was sold by debiting cost of goods sold, the expense, and crediting merchandise inventory. On the 20th, we purchased more books from Phantom Publishers. Terms are FOB destination, 2% discount if paid in 15 days. If not, the net amount will be due in 30. Purchase inventory on account. Increase inventory with a debit because we have more inventory. And record an increase to our liabilities with a credit. We now owe more for that purchase. On the 24th, we granted the Willow Bookstore, whom we sold to back on the 17th, a $120 credit for books they returned to us that cost us $72. These are books that we had sold. These are revenues. We are offering a return and allowance. We don't directly reduce the revenues. We use a contra revenue account. We will debit the sales returns and allowances account, increasing it for the amount of the returned sale, and decrease accounts receivables with a credit. We also need to record the inventory being returned to us. Our inventory has now gone back up by $72, and our cost of goods sold, the expense, has decreased because that inventory is no longer used up. It is now back into our shelves. On the 26th, we paid Phantom Publishers in full less the discount. Where did we purchase from Phantom? We purchased from Phantom back on the 20th. And at that time, we recorded a liability to them in the amount of $1,500. We are now paying off that $1,500 liability. So the entire liability is being paid off. We are going to decrease our liability with a debit. We do not have to use $1,500 in cash to pay off that liability because we can take a 2% discount for paying within 15 days. The 2% discount is going to be $1,500 times 2% or $30. That means we only use cash, $1,470, credit cash for the amount of cash used to pay off that liability. We have to adjust our inventory for the amount of the discount because this is inventory we purchased, and we want the cost of the inventory that we have recorded in the ledger to reflect its actual cost. So we will decrease our inventory by $30 with a credit. On the 27th, we received payment in full from Willow Bookstore. We had sold to Willow Bookstore on the 17th. Sold them $1,300. Willow then returned $120. So we were originally owed $1,300 from that sale on the 17th. However, we decreased the amount that was owed by $120 when they returned some of the inventory. So when they pay us, the amount that they have to pay is the $1,300 owed less the $120 credit. They have a receivable being paid off of $1,180. We decrease the receivable because the entire receivable is being paid off. The amount of cash we receive for that payable or for that receivable will be 2% less. So instead of, whoops, that number is wrong. Okay, I corrected that number. All right, so they owe $1,180. The discount will be taken off of what they now owe. So $1,180 times 2% is $24 rounded, which means that they only have to pay cash of $1,156. So our cash increases $1,156 with a debit. And remember, this is relating to a revenue. So we use a contra revenue account to record the revenue given up for the discount. Final transaction on the 30th, Paul's Warehouse purchased supplies on account for $350. This is simply an increase to their supplies with a debit and a credit to their liability accounts payable. Let's take a look at this exercise. This has us dealing with adjusting for a difference between the amount of inventory we have recorded in the general ledger and the inventory that is actually physically on hand. Obviously, inventory disappears. It's broken, it falls off the shelf and breaks, and it's thrown away, or it's stolen. When companies take physical counts of inventory, they reconcile the inventory count to what's recorded in the general ledger. So here, this company had the following account balances at the end of the year. They had cost of goods sold of $60,000, inventory of $15,000. And here's some additional information about expenses, revenues, discounts, returns, and allowances. A physical count of the inventory determines that the inventory that is on hand is $14,100. However, they have recorded in the general ledger a balance in inventory asset of $15,000. We need to adjust that inventory to reflect the fact that $900 of that inventory is no longer on hand. It's very simply done by, well, there's different ways to do it. We're going to learn the simple way to adjust for it, and that is to debit cost of goods sold. What that ends up doing is increasing our expense of sales to account for the additional $900 inventory cost. And we are going to decrease the asset inventory by $900. This is the most simple and straightforward way of adjusting our inventory to reflect loss or damaged goods that are no longer on the shelves. The last problem that we're going to work with is this Oblique Company. This is for the month of March 2010. They are providing us here a whole bunch of information, some account balances relating to expenses, as well as revenues and contra revenue accounts. We're going to prepare a multi-step income statement. In the past, the income statement that you learned was very simply the revenues or the sales minus all the expenses to calculate net income. When you're dealing with a company that is a retailer or a merchandiser that sells inventory, we have an additional step that we need to take in the calculation of income, which is why they call it a multi-step income statement. The income statement still only reports revenues and expenses. However, what it does is it prepares an extra step in the process of calculations. We start with the revenues. Here are our revenues of $370,000. Then we're going to show how much of those originally earned revenues were given up or lost due to discounts, returns, and allowances. These are the contra revenue accounts. Remember, contra revenue accounts have the opposite balance of the revenues, which means they are going to offset or decrease the amount of revenues that we are reporting. So the original revenues were $370,000, less the contra revenue balances means the net sales, or the net amount of actual earned revenues, was $349. After that first extra calculation to calculate net sales, we then are going to single out one expense. We're going to single out the expense of the cost of goods sold. Take the revenues less the expense of the goods sold to earn those revenues to calculate gross profit. This is a new line item on the income statement that you haven't seen before. And gross profit represents the amount of profit made off of the sale of the inventory. Gross profit is not the same as net income, because net income takes into account all of the other costs of earning those sales. Freight cost, insurance cost, salaries cost, or rent expense. Those expenses are what we call operating expenses. Total operating expenses were $109. So if I take the gross profit of $137, and I actually think I would like that better over there in that column. If I take gross profit and subtract my total operating expenses, then I'm calculating net income. So the company had a gross profit of $137 by selling their inventory. Their operating expenses were $109, leaving them with an overall income of $28,000. To calculate the gross profit rate, we simply take the amount of the gross profit, which is $137,000, and we divide by the net sales. Let me also move that over. That looks a little bit better. Our net sales was $349. Gross profit of $137 divided by net sales of $349 means this company has a gross profit rate of 39.26%. What does that mean? That means that for every dollar in revenues, the company is left with 39 cents, or 39% of that sales dollar, to cover the operating costs of running the business. That is just what we call a financial ratio. It is a tool that we use to better analyze the financial reports instead of just looking at gross dollar amounts. All right, hopefully this helps. Reach out with any questions you may have.